Hi everyone. It's April 2nd, and right now S&P 500 is obviously trading lower in the after hours. Although I'll admit that this looks worse than what it really is in some ways because we were trading really around 56.10 going into the opening today, and so we're really only 1.5% below where we are at 9:30 in the morning, which certainly doesn't seem nearly as bad as 3.3%. Not that that maybe makes anyone feel better, but I just want to kind of put that reference in there because there was really no understanding on my part in terms of why we rallied at all today to begin with. There was really no reason for it. In fact, there's really been no reason for the rally the last couple of days, and I've been kind of highlighting that in the member area. Today just felt a lot like maybe short covering was taking place. We had seen the VIX really come down pretty hard all day long, and usually that's when puts are getting closed out. And so perhaps there was some nervousness going into the tariff announcement that resulted in these puts being closed, and that's what ultimately drove the market higher. And that's what ultimately, was really more of a short covering event. And then, outside of that, there really was no clear explanation as to why markets were moving higher overall. So from that perspective, I don't want to make it seem like it doesn't matter or brush it off, but I think that maybe that makes it feel a little bit better. Again, I'm not trying to make everyone feel good, but I'm just trying to point out that this move largely, again, 2% in the Nasdaq's a fairly decent move, but really we're just a little bit below where we were on the 31st. So again, just to kind of highlight, markets are obviously trading down quite significantly tonight, but again, some of this seems like it's coming off of some excesses that really probably shouldn't have been there. The bigger, broader question, of course, is what's going to really happen next. And, I think really for that, you have to kind of look at the fundamentals a little bit to understand, because while the technicals can give us levels that may or may not be important, really the fundamentals are what's going to drive where ultimately we go. And it really comes down to a question of, where do S&P 500 earnings end up? And really more importantly, where do these PE ratios go? And, when you look at where the PE ratio is currently at 21.6 for 2025, it's still a very high multiple. And earnings estimates, while they've come down some, they're still kind of elevated, and they seem somewhat unrealistic given the environment we're in. And I guess when we just take a little bit of a deeper dive and look at where earnings are historically, and really more importantly where valuations are historically, historically the S&P 500 trades with a median, not the average, but the median of 15.2. And, currently, even with the latest, declines, the index is still around 5 full points above the median. And so, I'm not saying that the S&P is going to go back to trading at 15 times, earnings, but at 15 times 265, you're talking about an S&P 500 that trades at 4,000. So there's a big valuation gap right now in the marketplace in terms of where it's priced and where it historically prices. Now, when you think about the market overall, and you think about the uncertainty in it, typically you expect market multiples to contract because people pull back on risk and they begin to delever their portfolios. And when we look at where, credit spreads and where the earnings yield is, for example, which is essentially the inverse of the PE ratio, what we see is that the S&P 500 earnings yields tends to trade with the credit spreads, with high yield credit spreads. And really, again, where you look at where high yield credit spreads are, for the degree of uncertainty we're facing, they're still pretty tight, and they're really not reflective even of where we were in 2022 or 2023 when there was arguably, there was a lot of uncertainty, but arguably I would say it was more certain in terms of what was going to be happening there because we knew exactly what we were contending with, which was inflation and interest rate hikes. In this environment, we're really confronted with the tariffs and the fallouts and what does that mean for the economy. And so I would argue that probably, credit spreads are still too tight, and we should see, credit spreads really moving up. And if credit spreads move up, then that's likely to mean that you're going to see the earnings yield of the S&P 500 move up. And that's another way of saying that you're going to get the PE multiple to contract. Now, the other and really the final issue, again, is we don't really know what the total impact is going to be going forward. But the one thing that also stands out to me, which is, again, part of earnings, is that right now analysts are expecting margins to basically be at their highest level ever. Basically, what we're doing is taking the 12-month forward earnings and we're dividing that by the 12-month forward sales estimates. And we're coming up with a median of about 10.6%. Right now, margins are nearly 300 basis points above the median. And that would mean that we could be facing a scenario where if margins start coming down because of these tariffs, companies can't pass on all the costs, margins begin to compress, earnings begin to come down. That means that the PE multiple may not really come down quite as quickly as you might like. And so there's risk to this $265 in earnings. And so if we just kind of take things at face value and think about, where, sales estimates are going to be for the next 12 months, and let's just say, sales estimates, let's just say there's no slowdown in sales and all we get ultimately is margin compression. And instead of having or let's say, 12%, and, if you have $2,037 in earnings, and then you multiply that by 0.11, you're at $224 in earnings. You multiply that by 15, you have an S&P at 3360. If you have, like I said, 2034, and you have a 12% margin, that's 240 times 15. You have an S&P 500 at 366. And so, what I'm saying is that there's room for both the earnings number to come down itself and for the multiple to contract. And again, nobody knows for certain how this is going to play out. But again, let's say margin of 12.5%, $250 per share, and let's say we don't go to a 15 multiple. Let's just say we go to 18. You're still talking about an S&P at 4,500. So what I'm trying to say is that given the amount of uncertainty, given the amount of what's going on in the market, while it's nice to look at the charts, understanding the fundamentals in this case are very valuable because you can begin to understand, where this market could ultimately be going. And if it is the case that we are going to start seeing multiples contracting, we are going to see high yield credit spreads moving higher. You're going to see earnings start coming down. Growth rates are going to begin to decelerate. It's really good to have an idea of where these earnings may be going, and more importantly, what the valuation may ultimately be. And at least you can get a sense of where the market could be heading. And so while it's nice to look at these charts and to see that we've broken 5,500 or 5,400, the next major level here is around 53. It's good to understand where your risks are, and your risks really potentially could be somewhere in this 4,500 to 4,800 area if you start seeing the fundamentals deteriorate. And again, this isn't meant to scare anybody, but this is meant to look at the reality of what's possible if we start seeing a real economic deterioration due to these higher tariffs, due to margin compression, due to earnings coming down, due to the multiples coming down. There's risk here that this could be a little bit more severe than I think most people really want to give it credit for. Anyway, have a great rest of your night, and I'll see you later. Bye.